Trideep Bhattacharya is joining us from Edelweiss Mutual Fund. Trideep, afternoon. This new scare of uh, slowdown, the global slowdown, as a second order effect of high inflation seems to, haunting the market globally, and India is also under pressure. Do you think that this slowdown can come back home as well? And if that happens, we'll have to shrink the valuation of the market further to adjust to this?
Good afternoon, Ajay, and great to be on your show. Good to hear your voice. I would say that I think the fear is for real. Just to recap for the benefit of viewers, since we have been talking on your channel for a while, we have been talking about a volatile first 6 to 9 months of the year, and we are gradually coming to the point where, according to our initial expectation, inflation this month or maybe in the next couple of months would actually peak. And after that, courtesy the base effects would actually start coming down. But before it starts coming down, there is a peaking element, which is what we are in the process right now. And hence, incremental data points oriented towards higher inflation is spooking the markets, and understandably so. My sense is that it is going to remain this way for the next couple of months till the time we have seen the worst of the inflation. And my sense is in the next couple of months, probably the next print will probably be the worst. And after that, it should start come off if as the flow of things go along. What does it mean from an Indian corporate standpoint and whatnot? I think oil is basically the main thing to sort of keep an eye on, apart from various other commodities. I think if oil stays north of $120, for a good while, I would say that rather than getting into this monthly discussion, I would say that if oil stays at $120 plus come Diwali, then I think there is a reasonable chance of demand destruction on the other side. And we'll have to kind of, prepare for some tough times, in the recessionary times or stagflationary times, whichever way you call it, over the medium term. But barring that, my current expectation is still that in the next couple of months, inflation should peak. It'll give a couple of nightmares like it is showing in the market today, but it should broadly peak in the next couple of months and should gradually come down, not to the levels that we have been seeing in the last 1 year, but certainly higher than that, but lower from where we are. That's the current expectations, but we keep an eye on it. Nobody is an inflation expert, and act accordingly.
When you talk to the corporates which you have in your portfolio, what is the feedback you're getting on demand destructions? Because, if Target and Walmart numbers are any guide, there is good amount of demand destruction happening in some of the consumption parts of the other parts of the world. I'm sure, companies back home here are also facing the challenge of either continuously keep on passing the price hike or negotiate lower demand or, adjust that in the business. How are they coping? Any feedback from the corporates?
Great question, Ajay, as always. I would say that before I get to the corporate commentary, just put a bit of context. So in India, the inflation that the Indian corporates are facing in domestic arena is similar to what they have faced probably in 2015-16. So, there has been time in the last decade or so where they faced similar kind of inflation levels overall from a CPI standpoint. WPI is obviously higher. But if you look at in the United States, the inflation that they are facing is similar to what they faced in 1970s. So that's clearly top of the charts as compared to what we are facing in India. So just wanted to place that in context, the situation that we are facing in India versus how you are facing in the United States. And on net balance, the inflation situation in the United States is probably more grave than what we are facing in India. But having said that, when I speak to corporates, yes, they're saying that Hindustan, even larger companies like Hindustan Unilever and the other staples companies have had to take price increases in double digits. And that has kind of, had to a certain extent impact in the staples volume growth in the near term. But what they are also saying is that there are incipient signs of, rural recovery, which is kind of starting to come through, which is why they're not outright bearish. They are sort of cautious on the volume growth over the next couple of quarters. But beyond that, they're hoping that some sort of better monsoon and rural recovery would effectively kind of bail the rural consumer out, or at least that section of the population which has got significantly impacted by the inflation will get some respite on the back of some rural recovery, so to speak. So, but barring that, I think corporates generally in the near term, which is what we are hearing in the March quarter and what they are setting the expectations for the June quarter, they are setting the expectation of fairly tepid volume growth. But on the other side, they are still hopeful that this rural recovery, etc., would actually kind of come back to health rather than kind of being on a continuous downhill slope.
No, that's clearly a point, and in the face of this entire global gloom and doom on growth front, even after adjusting lower, all these global agencies see 7.25%, 7.5% kind of growth of Indian GDP. So clearly, we have growth, and people are shrinking; their economies are shrinking. So my question to you is, in the light of fall in commodity prices, I was just looking at copper, which is a 7-month low, if I'm not wrong. Other metal prices also down 15-20% from recent top. Would you be constructively looking at commodity user companies from the auto space, from capital goods and some other areas?
I think increasingly, yes, is the way to answer your question. I think if you ask me, there is still 1 quarter of pain remaining with a bit of a backward bias. In other words, the commodity price increases that have already come through will impact the margins in the June quarter, so to speak, as well. And that will probably be the worst impact in terms of commodity price impact on the margins, because pricing power or pricing reflection usually happens in a couple of quarters, whereas the commodity price impact is fairly immediate on the margins. And I think the June quarter will probably see the brunt of the commodity impact, and the pricing power impact will not yet have come through. So basically 1 more quarter of pain remaining, and hence increasingly so is the way to look at it, but not in a gung ho or not in a jiffy, particularly with regards to the commodity user company. With regards to industrials, I think our view on the medium term in India has been fairly robust. I think we think that India, in the context of India over the last 10 years, and India in the global context, is looking relatively quite robust on economic terms. And hence we think that there's a good chance that we will see a CAPEX cycle still come through over the next 2 to 3 years. And hence we are positive on industrials, and our portfolios are struck accordingly. But incrementally, from a commodity user standpoint, we are starting our work on them. Hopefully in the next 3-4 months, we get better prices, which can be kind of interesting entry points.
After this fall, what is the after correction? What is the 1 year forward, kind of a multiple for your key portfolios? How much lower have they come down in the last few months?
Great question. So I think overall, this is something which we covered in the last interview as well, where we said that by and large, there's been a change in interest rate regime, just to set the context right. And in the sense that earlier we were dealing with falling interest rate for the last 10 years. And over the last 6-9 months, we are dealing with increasing interest rates. And typically when that happens, valuation contraction happens. So if I were to look at market in general, the market has seen a valuation contraction of anywhere between 20 to 25% over the last 3 to 6 months. I think we have been fortunate enough, and hopefully with a bit of skill enough, that we have avoided the high valuation companies in our portfolio. So while some of our portfolio holdings have taken a knock, to be very honest, but I think they have been kind of quite it's a limited few versus the kind of valuation adjustment that we have seen in particularly the high valuation, let's say new age companies, this, that, other. Since we by and large avoided that, our impact on the portfolios have been relatively limited of this valuation compression. But in general, to answer your question, across the market, we have seen 20-25% valuation compression, probably a little higher for the higher valued stocks. And I think that's driven by the interest rate regime change that we have seen globally as well as in India.
So can I assume similar kind of valuation contraction would have happened in your portfolios as well, or relatively lesser? So if you could say if your mixed portfolio, multi-cap, has come down to 15 times forward or 11 times, can you give me that kind of view?
Yeah. So basically the market today, right now, if you look at 1 year forward, is still at around 19, 20 times. Our portfolio is certainly lesser than that. It's basically 15 to 17 times, depending on which portfolio holdings you are looking at. But I think what we have to look at is that we think as compared to broader market growth, the earnings growth of our portfolio is also 5 or 6 percentage point higher. So relative to the market, the portfolio brings forward a better growth profile and lower valuations as compared to what we were dealing with certainly a few months ago. Hope that answers your question.
Right. All right, Trideep, we'll let you go on that one. Thanks so much. It's turning out to be pretty ugly out there. Dow futures have plunged another over 1% and, casting a big shadow on emerging markets like India as well, which is also sunk to a new low. But these are difficult times, and as an investor, you have to navigate through them carefully and intelligently, and that's why we are getting you the best voices to do that.